So in this video, you'll learn the 3 best candlestick patterns for spotting market reversals and how to use them in a simple day trading strategy. While I'll be demonstrating this on the 1 hour chart, these patterns work just as well on other time frames too. So let's start with one of my favorite candlestick patterns for these high probability situations. That's the railroad pattern. So the railroad pattern is a 2 candle reversal pattern that signals a potential trend change. It basically consists of 2 strong opposite colored candles, roughly the same size, side by side, just like train tracks, hence the name. This pattern shows a sharp shift in momentum, with either buyers or sellers taking full control after the first candle. When it's spotted at key levels, it can be a strong indication of a trend reversal. Here we have a great example of a railroad pattern. While there are some wicks, that's actually a good sign. It shows strong rejection of higher prices, and this pattern formed right at a clear resistance level, making it even more significant. And as expected, it triggered a decline. Now, you don't have to jump in immediately. You can wait for further confirmation to refine your entry, making it safer and more precise. The trade-off obviously is it might require a slightly larger stop loss. In this particular case, the railroad tracks themselves were quite large anyway, meaning a wider stop loss would have been necessary anyway. But yeah, ideally we'd place the stop loss beyond the pattern itself. If you want to reduce your risk, you can also wait for a pullback to a Fibonacci level before entering. So sometimes the market doesn't give you that pullback, but in this case we did see price retrace to around the 61.8 level, offering a great entry opportunity. The second candlestick pattern that we're going to talk about is the pin bar, which is probably the most well-known or most famous one used by traders all around the world. This is a single candlestick pattern, and it signals a potential reversal in the market. It has a small body and a long wick. Ideally, the wick should be twice the length of the body, but it's not a hard and fast rule. And the wick shows that price was rejected at a certain level. A bullish one would have a long lower wick, meaning buyers stepped in and pushed the price up, while a bearish one would obviously have the opposite, which is a long upper wick, indicating strong selling pressure. Traders use pin bars to spot entry points at key support and resistance levels. So here's a great example of a pin bar. This one has a long upper wick, signaling strong bearish rejection at a clear resistance level. As expected, price then dropped down, and it actually dropped down to this support level below, where we actually see another pin bar, but this time it's bullish. And that's a point to remember, that pin bars aren't just useful for trade entries, they can also serve as exit signals, just like this. The bearish one up here led to a pullback as well, so that could have allowed you to get a better entry because it's pulled back to around 78.6% Fibonacci level, I think. It's gone way beyond the 61.8, so that would have provided an opportunity to enter with a tighter stop loss. But as always, the stop should be placed above the pin bar to account for any volatility. Here, just a couple more pin bars to give you an example. So there's one here, that's obviously bullish, and another one here, which is also bullish. But yeah, pin bars are very effective and probably the most popular, as I said. Okay, the third pattern is the morning star or evening star. So I'm going to talk about the morning star, but the evening star is just basically the morning star in reverse. So the morning star is a 3 candle bullish pattern, bullish reversal pattern. It appears at the bottom of a downtrend and consists of a big bearish candle, followed by a small bodied candle, which can be bullish or bearish, doesn't matter, and then a strong bullish candle up. This formation signals that selling momentum is fading and buyers are stepping in to reverse the trend, and it's a powerful pattern when it forms at key support levels, often leading to a strong upward move. So in the opposite case, it would be an evening star, and I've got an example here of an evening star. So this is an evening star, and it's essentially a reverse of the morning star, as I said, making it a bearish reversal pattern. This one's formed right at the resistance level, adding to its significance. Now, while the second candle in the pattern is a little bit short compared to the bullish leg up, we can take the following strong bearish candle after it into account. On a higher time frame, this entire move would likely be considered as part of the same leg. So if you think about it that way, let's say on the 4 hour chart, that's an important tip to keep in mind. The key takeaway with the evening and morning stars is what they represent, and that's potential reversals. The pattern forms after an impulsive move into a level, followed by an equally strong rejection. In this case, we see that rejection confirmed by the bearish candles after the doji, signaling a shift in momentum. So those are 3 of the best candlestick patterns for spotting these market reversals, and as you've seen, they work well when combined with other things like key levels or Fibonacci retracements. And yeah, if you found this useful, be sure to like the video and check out my other videos where I've got strategies such as moving averages, which is used for day trading, and also action reaction,